you that most of the money in your bank account doesn't actually exist the way you think it does. We're taught from an early age that money is simple. You work, you save, you spend. But what if that was only half the story? What if the system was designed in such a way that no matter how hard you work, you'll always feel like you're falling behind? Here's the shocking part. Governments don't create most of the money we use today. Banks do. And the way they do it explains why houses keep getting more expensive, why jobs feel harder to find, and why debt has quietly become the oxygen of modern economies. The hidden truth about money creation. When most people picture money, they imagine cash notes, coins, the kind you can hold in your hand, and while that still exists, it's just a tiny fraction of the total money supply. Only around 3 to 5% of all money in circulation is physical paper and coins. The remaining 95 to 97%, it's nothing more than numbers on a screen, digital entries in a computer system. And here's the catch. Those numbers aren't created by governments or central banks. They're created by commercial banks. Here's how it works. When you go to a bank and ask for a loan, whether it's for a car, a house, or even a small business, the bank doesn't go into a vault and hand you cash someone else deposited. Instead, it simply types the loan amount into your account. Just like that, brand new money is created out of thin air. The Bank of England even admits this openly. Commercial banks create money in the form of bank deposits by making new loans. That means when you take out a mortgage, the bank isn't moving money from one pile to another, it's inventing it on the spot. Now you might be thinking, so what? What's the big deal if banks create digital money when I borrow? Well, here's the problem. This system is exactly why the average person today struggles to buy a home, why good jobs feel scarce, and why our economies seem to constantly swing from boom to bust. Because banks aren't lending based on what society needs. They lend based on what benefits them the most. And surprise, surprise, real estate is their favorite playground. Think about this. Every time a bank creates a new mortgage, it's creating brand new money. That fresh money flows into the housing market, and just like Santa Claus suddenly doubling everyone's bank account, prices shoot up almost instantly. In the UK, between 1997 and 2007, around 40% of all newly created money went directly into the property market. During that same period, house prices rose on average 7.7% per year, while salaries crawled up by only 0.8%. Now multiply that effect across decades. Is it any wonder why your parents or grandparents could buy a home with one income, while today two people working full-time still struggle to make mortgage payments? This isn't about population growth or immigration alone. It's about how money itself is created and where it flows. And right now, the flow is flooding housing markets, inflating prices far beyond the reach of ordinary people. It's not just housing either. If you trace where new money goes, the picture gets even darker. In that same UK example, 40% went to property markets, 37% went to financial markets, 10% went to credit cards and personal loans, and only 13% went into actual businesses, the kind that create jobs, build industries, and grow economies. That means nearly 80% of all new money ended up in places that don't produce real economic growth. Instead, they inflate assets, homes, stocks, financial products, while ordinary people are left competing for fewer jobs, higher rents, and rising costs. The result? Massive youth unemployment across entire countries. In Italy, around 40% of young people under 25 are unemployed. In Spain, that number hits 56%. In Greece, it's an unbelievable 60%. All because money isn't being created for productive purposes, it's being created to chase profits. And here's another piece of the puzzle. Digital payments may feel convenient, but they've handed banks even more control. Think about it. Every time you tap your phone, swipe your card, or make an online purchase, that transaction flows through the banking system. Banks don't need armored trucks, branches full of tellers, or costly ATMs anymore. Their expenses go down, their profits go up, and society gives them even greater power over money itself. So while we celebrate convenience, we've quietly allowed the private banking industry to merge two powers that should never be combined: the power to create money and the power to decide who gets it. This fusion of money creation and profit-seeking lending has created three massive problems: instability, inequality, and concentrated power. Instability. Banks lend aggressively when the economy is booming, pumping more money into bubbles. But when a crisis hits, they slam the brakes, starving the economy of cash when it needs it most. It's like an umbrella shop that sells only when the sun is shining, but shuts down the moment it starts to rain. Inequality. Interest works like a tax. But unlike normal taxes, the rich pay less. If you're wealthy, you borrow at low interest rates. If you're poor, you pay much higher ones. The system ensures that wealthier individuals and nations get richer, while poorer ones sink deeper into debt. Power. Whoever controls the creation of money controls the economy and, by extension, society. That's not an exaggeration. If a handful of private banks decide when to create money, how much, and for what purpose, then governments lose the ability to steer their own economies. Politicians might argue in parliament, but the real decisions are being made in corporate boardrooms. Here's the part that shocks most people. In our system, money equals debt. Every dollar, pound, or euro in circulation exists because someone went into debt to create it. If nobody borrowed, there would be no money in the system at all. So when politicians talk about paying off the debt or living debt-free, they're essentially describing a world where money ceases to exist. It sounds responsible, but in reality, it's impossible under the current system. That's why economies constantly need new debt. To grow, to function, to survive, someone has to borrow more. Without it, spending collapses, businesses fail, and jobs disappear. It's a treadmill that never stops. At this point, it's tempting to say money is evil, but money itself isn't the villain. It's just a tool, like a hammer or a computer. The real problem is who controls it and how it's created. By giving banks the keys to money creation, we've handed them enormous power over our lives, over housing, jobs, and even politics. And unless we start questioning that power, the cycle of debt, inequality, and financial instability will only get worse. So the next time you check your bank balance, remember, those numbers on your screen aren't just money. They're a reflection of a system designed to keep society borrowing, struggling, and chasing after something that may not even exist in the way we believe, because if money is power, what happens when all that power belongs to a few?